All right, we're back for another episode of the Mortgage Show. Beds, how you doing?
Take two? Round two, Randy?
This is take two. No one will ever see take one.
Yeah, I'm doing good, buddy. How are you?
Still recovering from Jayson Tatum's ruptured Achilles. How are
Mm.
you handling that?
I haven't accepted it yet. How about you? It's like you know it's there, you're gonna have to deal with it, but in the back of your mind, you kind of keep pushing it off. Man, what a loss. It sucks.
I was telling you yesterday. It's still, or I was telling someone I think yesterday. Just I haven't felt like this since Gordon Hayward snapped his leg opening night of whatever season that was, 5, 6, 7 years ago. Brutal, just brutal feeling.
Buddy, the Celtics have had this weird run of like worst case scenario. Like every decade something happens and it's just such a buzzsaw. Big Celtics fan over here. Obviously you are.
Yeah, we're gonna post this on Thursday morning. Game 5 is tonight, so we'll see what happens. I don't know. They're going to have to dig deep, make a run for it. Indiana's going to be tough in the next round. So I don't know if they somehow can overcome the 3-1 deficit in this series. They have another tough matchup without Tatum. But we'll see. Just got to win one. Just got to win one.
Just one. Chip in a chair.
Someone shared in our text string that the Knicks have led 20. Were you on the same text string for this? The 24 minutes the Knicks have led in the series, which
Yeah.
is the fewest amount by a team leading a series at this point, which doesn't make me feel any better. It actually makes me feel worse.
It's crazy. I mean, I guess since we're talking about it, it's like I actually pay attention to this simple area of like, is basketball aesthetically pleasing? Are they moving? Is there synergy? Are they making the right plays? And there's one human being on that court all the time that throws a wrench into this team's sort of area of moving forward. And, the guy's Jalen Brown. I love him. But man, the way that he's been playing, it's just been so disruptive towards. I've noticed innumerable times that we're going and we're going and we're going. He'll just throw the ball away. He'll just
Yeah.
dribble it off his leg. And dude, when you're playing sports, if you have a teammate that consistently does that, it makes you salty. You don't play like you should if you're feeling it. You know what I mean?
Frustrating. Dude, totally frustrating. And honestly, him mishandling the ball to some degree is what led to Tatum blowing out his Achilles anyways. Now, I don't know how Achilles works. If this was inevitable, if it wasn't that play, it would have been another play. But,
Yeah.
that was Tatum lunging for the ball that he mishandled and then blew out his Achilles. So, very frustrating.
Yeah, it sucks. If you watch the replay, it's just basically irregular movement very quickly, and that whole band area just holds the whole load, and it just can't, and it releases and it snaps.
Yeah. So, it was odd. I don't want to spend all podcast talking about this, but hey, this is who we are. It was odd that they released the statement that his Achilles had ruptured after they had already fixed it, which is strange. I don't know if that's normal, but I just don't remember a time where someone ruptured their Achilles. No one had that confirmed, and by the next morning they already repaired it and made the announcement. Strange. It seemed like they just jumped right on it.
We're on to 2027.
Yeah. Oh, so frustrating. We are on to 2027. Do you want to move on to mortgages?
Well, yes, one quick question. Why can't
Sure.
we have nice things, Randy?
Many people would say that we have a lot of nice things and have
Yes.
had a lot of nice things. So
Yeah.
trying to focus on that, I guess, right now.
Yeah, let's do it. All right. Let's dominate this mortgage pod. It's time.
Hey, do you think your screen could shake anymore?
I'm sorry, buddy. I do that to you all the time. I don't like it when I throw you off. I'm going to stop touching things.
Okay, bunch of mortgage stuff to talk about today. Why don't we start off with just some economic news?
Yeah.
CPI was released yesterday. Do you want to talk about that for a second? That's obviously a big driver for mortgage rates.
Yeah, in the background here, I've got the week of the economic calendar. The only light day is today. There's actually nothing. Monday was actually light day, but Tuesday was all of this inflation data, with food, with energy, excluding both of those. We're actually sitting in a really good spot with all of these indicators. Like inflation seems to be in a very tame area. Month over month, maybe we went up just a little bit, but again,
Mhm.
still below expectations. So, big day yesterday, and it looked really good for the economy. So, what does it mean for interest rates is another thing. It's kind of interesting where this topic continues to put rates in this weird area where it's pushing them up a little bit, and that's what we've
Yeah.
experienced since yesterday.
The news that we've gotten over the past few weeks are things that historically would have pushed rates down. I don't know if we talked about it in the last podcast, but just the tariff stuff you would have thought would drive down interest rates, and it didn't quite do that. So yeah, we're in this weird spot of, great, these indicators are coming out, and what we expect to happen doesn't always necessarily happen. I will say rates are at a 2-week high from what I've seen right now. Not like a spike, but like it's not like rates have gotten better over the past 2 weeks. So we're kind of dealing with that in the market right now.
A little bit more to talk about is Thursday. Big day. CPI, computer producer price index, retail sales. I love where my brain goes sometimes. It's like I get lazy on a thought and then just autopilot just completely kills me. Retail sales, the Fed speaks at 8:30. Powell's going to chat for a little bit. I mean, there's 15 things on this list. The manufacturing survey is also there. You know, these are big reports here that sort of describe what's going on in certain sectors of the economy. So a less than day is sort of good for interest rates, but if those numbers come in hot, it's going to put more upward pressure on interest rates. So
yeah,
as always, we obviously want sort of middle of the road.
Yeah. So we'll be watching and we'll be spreading the word with our referral partners and the people we're working with, obviously always trying to get the best rates for people, but interest rates are not set by banks or lenders. It's market driven based on the 10-year treasury and a lot of things behind the scenes. So we'll continue to monitor that stuff and share information with it with people as we get it. Do you want to move on to something else, Beds?
Yeah, I think we're good. I think we're good in this area.
Okay. So the thing I want to talk about next is Maine State Housing. We've talked about Maine State Housing before, but just to reiterate what Maine State Housing is, just a government program through the state of Maine, and it kind of piggybacks on top of some existing types of loans that we have, USDA or rural development, FHA, VA. There's some conventional variation of Maine State Housing. Great program for a few different reasons that I'll run through. Interest rates are fantastic compared to regular mortgage rates. It's the only program that we have where the rate is just set by the government entity in this case. 5.95% is the rate for 30-year fixed with that. You can typically get a $5,000 credit towards closing costs if you're a first-time home buyer, $10,000 if you're a first-generation home buyer, all kinds of good stuff. The downside is there's income limits, right? And a lot of people in southern Maine make more money than these income limits that disqualifies them from using this type of loan. Maine State Housing increased those income limits in the past couple weeks. So I was going to go over those, Beds, if that's cool with you.
Yeah, hit it, because this is good. Higher in this area is a good thing. It actually opens up more opportunity for borrowers. So this is cool.
Yeah. The thing that's tough, and I'll go over what it was and what it is now. It's not like it's that big of a difference, but it is something, and it's something that people should know about, because believe it or not, I've had people that are right on the cusp and they might be $1,000 over this income limit, and that's the difference between them qualifying and not qualifying. For those people, with the amount that it's gone up, now they would be all set to go. So anyways, the markets that we focus in primarily, so it's like the cities of Cumberland County and Northern York County are in this own group where they have the highest income limits in the state. Previously, if it was a 1 to 2 person household, that income limit was $127,500. It's gone up to $129,800. So in this case, it's like a very minimal increase. For 3 or more people, it was $146. Now it's $149 and change. So again, small increase for those, but that covers a big part of where we do business. So that's that. The other part, which this freaking blows my mind, but our office is in Saco. Bedford Saco is where we're from. That's like the main place we do business. Those 2 towns are not part of the area that I just told you. It falls into York County, Cumberland County in general, Saginaw County in general. The income limit prior to this was $102,100, and now it's $112,060. So that one went up $10,000. Mm-hmm. For households of 3 or more, it was $117,000. Now it's $128,000. So that's good, but that's still pretty low, right? Wouldn't you say it's pretty low for some reason, Old Orchard Beach is in that higher bracket, but Bedford Saco is in that lower bracket. And it's a $18,000 per year difference, which is a big difference for some people. It makes no sense why it's not the same across southern Maine.
Number 1, good use of Sagadahoc. How do you
did dominate that, considering I've never said that word out loud.
I need to see it written. How did you say that?
Sagadahoc.
Okay. Good use.
I don't even know where it is.
Yeah, me neither. It is weird that Bedford and Saco is not in the higher cluster.
Kennebunk, Wells, Sanford doesn't fall into that. Makes no sense.
And that's a big thing too. As a LO, you need to really pay attention to the differences in that York County cluster of of median income. Because if you screw that up, I mean, you're telling somebody that they could do a loan that they can't. So it's like you go into these loans with good intentions, you disclose it, it gets an underwriting, and then you'll get killed because you screwed up the income. So
For sure. And it's important to really button that stuff up. York and Kittery was previously more like that first group that we mentioned in the 100 teens, and now they're up to 128,000, 200 for a family up to two, three or more it's 147,000. So for some reason, Berwick, Elliott, Kittery, South Berwick, and York have that higher income limit.
yep.
And then Old Orchard, Hollis, all the general Portland area have that higher number. And then again, Biddeford, Saco, Sanford, Kennebunk, Dayton, Wells, all those for whatever reason are in that pocket of lower income. My hope is that changes eventually. But I do have borrowers that it's tough because I have a borrower that makes, I think it's like $125,000. They make too much for that York County group, but under for the other one. So I'm always like, you have to look in Old Orchard, you have to look in Hollis, you have to look in Leamington, you have to look in Buxton, Gorham, and then they'll find a place that they love in Sanford. And I'm like, you can't do this loan in Sanford.
Yeah.
You just make too much money. There are other types of loans, but as far as this type of loan goes, you can't because it's in this town. It's just a tough thing for people. It's frustrating for them. It's frustrating for me to have to tell them, but that's just the way it works. Good news is, if I'm going to be optimistic, is that the income limits went up, and my hope is that they continue to go up, and that at some point, all of York County has the same income limit. It's not just those towns in the very north and the towns in the very south.
Are you finding yourself wanting to stack that with the RD program or the FHA one? What goes into that decision for you? Is it a no money down decision versus they have some money behind the scenes?
In general, it's been a no money down scenario for me.
RD.
Most people that do main state housing for me are going to do the one with no money down, and there's a whole bunch of debt to income ratio limits that go on behind the scenes. But typically, when I would choose between USDA and FHA, I would choose FHA because it's so much more lenient on the debt to income ratio. But when you have main state housing, they're the same between the two. So it's like there's no real reason to do the FHA version, because if you're going to be under that limit, might as well just do the no money down one. So anyways, that's the way it's been for me. Definitely a program I talk a lot about with people. Got a lot of people that are pre-approved for it. They're on their searches. It's just a matter of finding a seller that's willing to accept that offer.
Yeah, and one thing we should reiterate is, you're getting a credit, but you also need to make sure that the borrower is putting 1% of their own funds into the transaction. So, if you're getting a $5,000 credit and your closing costs are like $77,000, let's say, and it's a $300,000 purchase price, you're only going to use $4,000 of that $5,000 credit. So, you agents talking to buyers, you just always need to condition them in their price ranges to make sure they're using that 1%. I mean, we have to make sure we're calculating it when we're doing the loan, but that's a big thing to know.
Yep. No, it's worth mentioning. It's something you can easily forget to tell people on the front end of things. But 1% of your own money into the transaction to get that credit towards your closing costs. So keep that in mind. That's all I want to talk about with main state housing. It's a good program. Those are the changes. So just kind of keep rolling.
Yeah, let's roll it.
So next thing, mobile homes. I feel like more than ever, people are reaching out to us about mobile homes, and we've talked a lot about them in the past year since we've been doing the podcast. But what I wanted to do, if you want to pull it up on your own end too, is just go over the checklist that we have with some of the key features that we have to point out to people, because people are always asking us what's doable with mobile homes. So I'm going to run through some of the key things and just chime in, Beds. Okay. So manufactured home checklist. Let's see what we got here. We can, and I should say, we can do single wides or double wides. So that's not a huge issue now. Big thing is the home must be built on or after June 15th, 1976 to meet HUD guidelines. That's pretty standard, right? That's something that we've known about for years.
That's huge.
This is a big one. The unit must not have been previously installed or occupied at any other site or location, which is an interesting one, because I actually had a deal that was killed because it was moved.
Yeah.
Have you ever had that?
Actually, an offer just went out the other day, and the listing agent was awesome. The details in the sort of the MLS were actually pretty vague for whatever reason on that listing, but the listing agent actually did tell the buyer agent, look, this has been moved, check with the lender. And then once I was checked with, I was like, hey, I can't do that. Can't do it.
You can't. Yeah.
Yeah.
You can't do it. I did not realize this until I had the deal blow up for me. Like, no one knew it. It wasn't something I had previously dealt with. I'm like, why would it be moved? Come to find out, I think I don't know if it was in the 80s, there was a flood event in the southern part of the country, in the Louisiana area,
Mm-hmm.
and a bunch of single wides were relocated from the south up to Maine
Oh, no kidding.
and the Northeast in general. So it's not that uncommon for single wide mobile homes to have not been in their original location, considering they came from the south and were repositioned on new foundations up here in the north. So it is actually fairly common. So it's something that you should mention to people when they're doing a mobile home. But yeah, if it's been moved for whatever reason, just guidelines don't allow for it. So
My mind goes to this area where it's like, I did not know that. So that's some good stuff right there.
mhm.
Had no idea about that. So I would guess that those were moved because they were still in good condition. And it's like, all right, people up in Maine can use them. Let's provide that and let's make everybody's life easier and provide some more housing. So why are we in this area of lending where we don't have this sort of checks and balances of a property being moved? Like I'm like, why can't we have something that determines that move is not detrimental to our mortgage guidelines? The smarter people know the answer. That's one of those ones for me.
Yeah, I don't know if it's a condition thing. If something's been moved, there's a concern about the overall condition of it and makes it less marketable. I don't know, but that's definitely a thing. So I'm glad we're both well aware of that at this point. Towing hitch, wheels, and axles must be removed. Pretty straightforward.
Yep.
Must be titled as real estate, meaning this can't be in a park. We don't really lend on places in a park. As far as I know, the only place that does that is Atlantic Federal Credit Union. So I'm always happy to tell people that.
Can I add something? I went down the rabbit hole once on a lease on mobile home park. There's some language in a lease that might allow Fannie and Freddie to accept it. I believe it has something to do with the loss in the case of a foreclosure on it.
Yep.
There's some language in there where the park, I guess, is in front of that. So if the lease in the park is the reverse, we could possibly get it accepted.
That's good to know.
Yeah, that's good to know. And have I run into one yet? No, the answer is no. I've tried it twice.
A couple other things. Fannie, well, we should say that all of these loans, like double wides and single wides, are eligible for FHA, VA, RD, or conventional financing. So all these main types of loans that we do are eligible for these type of properties. Fannie Mae and RD requires the homes to be a minimum of 12 feet wide and 400 square feet. Freddie requires 12 feet wide and 600 square feet. So keep that in mind. Usually that's I have not seen that to be an issue. One thing I should mention is an engineer's cert is required on the foundation if you do an FHA or RD loan, which honestly tends to be a lot, on at least for me personally. It's buyers that are more focused on those government type loans are doing these mobile homes because that's what they can qualify for. Keep in mind they have to do an engineer's cert, which is important. Make sure the foundation's okay.
Could we talk a little bit of what that looks like cost-wise and the agent's role in it?
Yeah. Well, I mean, tell me your experience, but I was referred to a great guy on the last one I did. It was sometime last year. He got it done super quick, got it done within a week, and I think he was like $600 or $800.
Oh, okay. All right.
I don't know what have you had a similar experience or you just haven't had any experience with it?
No, I have. Mine was a little bit under $500, and that was a referral ultimately from another agent to the buyer agent that was working my deal. I hate that every time I do one of these, I'm searching for somebody to provide that. I should be keeping better records of that, but I have now mentioned it more often when offers are going out to just make sure we have to calculate some cost here for the engineering report, and that needs to be done.
Yep. No, it's good. It's good to mention that on the front end of things. And then honestly, just to schedule it earlier in the process instead of scrambling at the end. Last couple things. RD requires that the mobile be manufactured within the past 20 years, which I have someone under contract that has a mobile home that was built in 2010 right now, so it definitely happens. But that's a big difference than that 1976 date that we mentioned at the beginning. So keep that in mind for that type of loan. Last thing I should mention is interest rates for mobile homes are typically elevated versus normal interest rates for existing single-family homes. So if you're buying a mobile home as a borrower, know that the rate's going to be a little bit higher. If you're an agent, just know that your borrower's rate's going to be a little bit higher for that type of property. Just is what it is.
It is what it is what it is.
Yeah. Any other thoughts on the manufactured home stuff, mobile home stuff?
Yeah, I guess the down payment minimums 3.5% FHA, 5% down conventional. VA will allow you to do 100%, and like you've mentioned, RD is no money down.
Yep. So let's see. Next up, beds.
Are we pumping?
Do you want to talk? What's that?
We're pumping fastballs right now. Let's do this.
I think so. Let's talk about how to compare lenders, loan officer situations based on the loan estimate that gets sent out.
Yeah.
So I'm going to be fancy here and share my screen if you're up for that.
Let's go.
See if I can get this figured out, man. I think I will. All right. So what I have here is page 2 of a loan estimate. I think this is actually important for anyone to see that's listening still at this point. But every lender, every time you do a loan application, a loan estimate gets sent out that breaks down all the details of the transaction, the loan amount, the interest rate, whether or not that's fixed, what the payment's going to be. And then on page 2 is a list of all the closing costs. This is a closing cost detail. And this is just an example that I pulled online. So it's not particular to any transaction, but it's important to know that it's important to know aspects of this when comparing one lender to another, because the reality is there's really only one area that applies to a lender, and the rest of those things are going to be basically the same from lender to lender, transaction to transaction. So I'm just going to dig in and then chime in. Okay, Beds?
I'm gonna piggyback your block A with something in escrow.
Yeah. Okay. So, all right, hold that thought for a second. So block A, if you look in this top left area, origination charges, these are where lender fees would be. Okay. Most common is an underwriting fee, origination fee, processing fee, something like that. In our case, ours is around $1,500, which is pretty standard for the industry. In this example, nothing is there, but that's where it would be. If a borrower was paying points for their rate, which again, so we're all on the same page, points is paying fees to lower your interest rate. And a lot of times lenders are upfront about what that is. Other lenders just kind of sneak it in. They say what the rate is, and then they put the points there and then kind of hope that the borrower doesn't ask any questions or really know what's going on. If there are points, it would be there. So points and origination charges are all in that first box. And if you're going to compare one lender to another, it's as straightforward as comparing the rate and then what's in this box to see what the true costs are from lender to lender. So I don't know if you had anything you wanted to add there, Beds.
Yeah, I think cruising through the rest of that, I don't like that sometimes. So you're very right with the block A. So that's just as clear as day. It's like cut and dry. If our number is greater than somebody else's, our fees are higher, and vice versa. There's this area when you're producing a good faith estimate or a closing cost detail, if you will, that you could sort of sway numbers to make it look better for you as a loan officer. And this is the area that I don't like whenever I'm competing with somebody, is that after all of these years, it's so easy for me to look up a tax cycle, look up a proper amount for taxes, and just fill out a decent depiction of what the escrow will be at closing. Like a lot of times when I'm competing, you'll notice that the lenders will sort of throw in minimal numbers to make their closing cost detail look, smaller. I'm always going to try to nail that cycle just so the borrower knows what they're getting themselves into. So your block A, super solid, area to be, but that other area is like, it's a little bit of the fluff area where you're kind of like cheating it a little bit.
So, all right, let's talk about that.
Yeah.
I want to get that. You're talking section G, maybe section F, but if you look at section B, appraisal costs are pretty similar across the industry. $500 is too low for what's on this screen right now, but appraisal at one place is going to be generally the same as the other. Same for a credit report, same for a flood cert. So that's all computer generated regardless. Like I can't edit those numbers. It's just going to be what it's going to be. The next ones, section C is title related charges. So on any transaction, a borrower is going to have to do a title search and you're going to have to hire an attorney or a title company. And based on whatever one that is, we just click them from a drop down and it pre-populates their fees based on what their fees are, but also what the title insurance is based on the purchase price and the loan amount. So again, those are calculated. There's no real fluff there. Going up to section E, you have to record a deed and mortgage on any transaction. It's usually around $120, depending on how many pages it is. No fluff there. Transfer tax, which is blank in this one, is $2.20 per $1,000 in value of the home. So that's just going to be a pure calculation based on the purchase price. There's no fluff there, and that has to be disclosed exactly. But F and G are getting back to what you said about where you can BS things a little bit. Again, you can BS it, and it ends up changing by the time you get to closing, and everyone gets mad at you because it changed, or you can just disclose it up front. Some people choose to underestimate these things just to win a deal because the numbers look lower in totality. But the right way to do it is just to give the real depiction, because at the end of the day, it's going to be the same from one person to the next. Meaning, if you look at section F, homeowners insurance premium, it's blank on this, but a borrower is going to have to get homeowners insurance. They're going to have to pay for 1 year in advance. whatever it is what it's going to be, regardless of if you use us or a different bank, right? But if someone, if one loan officer puts, it's going to be 600 and the other loan officer puts 1200, the one that puts 600 is obviously going to look lower, but the reality is that we're just kind of spitballing at that point, and you have to get an actual quote and what it's going to be, what it's going to be. So.
Yeah, man, you just killed that. Nice job. Very good job, actually. And one of the things that I know we do is like when we're sending out these good, these cost analysis is I'm always telling people, hey, look, this is the number that I threw in this estimate, but it has nothing to do with anything that's etched in stone at your closing. You are going to shop for your own insurance, and when you get that number, we're going to use it, and then we're going to prorate it properly.
Yeah.
Property taxes.
Can we talk about interest real quick?
Yeah,
because I think this is something people don't realize. You are always going to have to pay interest
in advance
at closing.
From
what's that?
In advance.
In advance from the day of the month that you close through the end of the month. Okay. So in this case, you'll see it's $10.42 for 15 days. So this assumes that this transaction is closing on the 15th or the 16th of the month, depending on how many days are in that month, right? You got to pay that amount of days of interest. So again, from closing through the end of the month. All right. There is a room for a little bit of fluff here if a loan officer really wanted to. If they really wanted to, they could disclose this form, assuming you're closing on the last day of the month.
Yep.
And only showing 1 day worth of interest, as opposed to whatever the real day is. Say you're closing on the 10th day of the month and you have to pay 20 days of interest. There's a big difference in that line item between borrowers closing on the 20th day, the last day of the month, or the 10th day of the month. It's going to be what it's going to be, because you're going to close on the day you close, and the calculation is going to be what it is at the end. But again, loan officers could pull some funny business there, and I've seen it before. But that's just something to aware of. Most people don't realize that they have to do this at closing. And honestly, I'll say too, a lot of times borrowers are like, hey, what are my closing costs going to be? You must get this question all the time.
Oh, yeah.
What are my closing costs going to be? And it's like, there's a lot of things on this form that are fixed from transaction to transaction. Like the appraisal fee is going to be the appraisal fee. The title attorney fee is going to be the title attorney fee. The recording fee is going to be the recording fee. But some things are going to vary based on the transaction itself. And this one in particular, on the day of the month you close, if it's a big loan, that could be thousands of dollars. It's the difference between closing on the first day of the month or the 30th day of the month. So it's like very hard to estimate exactly what closing costs are going to be for anyone that's just asking you out of the blue without some type of detail as to when you close.
Dude, I love what you're doing right now. You're hammering this. I'm sitting here thinking, what do I have to add? The answer is nothing. Randy's crushing it right now. So.
Well, why don't you talk about the escrow piece too? Because this kind of gets back to what you were saying. This is the last piece where there's the potential for fluff. You can see what's going on here, but why don't you talk about that piece?
So your property taxes, we have to take the yearly property taxes, divide by 12, and assign a monthly figure to it. So if you're first of all, if you're misrepresenting that number, there's no tolerance that holds us to misrepresenting that number. So if you're a loan officer trying to sort of lower the numbers of a good faith estimate, maybe you're using an old tax number, putting your head in the sand. So your amount of taxes per month and then the amount of months that are collected. So let's take a look at G in this column. It's 416.67. They're saying the proration is 9 months at closing, 37.50. What if I was producing a sheet like this to win a deal and I said the taxes were 385 and there was only 6 months of proration? So obviously that 37.50 figure, mine's going to be in the 26 area. And I'm looking better by $1,100. But here's the thing with this. That is not a tolerance item. We do not control escrow. But as a loan officer, I mean, we need to do a good job for our clients. We need to give them the proper depiction. So I guess it's one way to sort of make the numbers look lower, but we're not held to any sort of, we could do it without anything sort of affecting us.
We could put zeros in that box. And then at the end, when it's $4,000 like is there now, we could just be like, sorry, I didn't know the calculation at the time.
Yeah.
And there's nothing that makes us have to cover that $4,000. It's just you're $4,000 higher. But that's an extreme example. But like you said, a loan officer could say, hey, you only need 1 month of insurance and 3 months worth of taxes at a lower amount. And their total closing cost figure looks lower than the other lender by that amount. And it's enough to win them the deal, even though they're not given an accurate depiction of what the real total is.
Yeah.
So it really comes down to who you want to work with. people that are going to give that accurate depiction. So by the time you come to closing, you're within a few $100s of what it ends up being, or the people that just want to win the deal by depicting an artificially low number just to win it.
Yeah, and so with all of these costs, these third-party costs, Randy and I are responsible for making sure that we have the right figures in there. If we do not have the right figures, the loans disclosed, if we get over to closing, whatever the difference is in the numbers, we actually have to provide the credit as a lender to actually correct our inability to get those right at the beginning of this disclosing process. We are not in any of that area when it comes to escrow. So that's a little bit of the explanation of why we can move those numbers. But if you do your job right, you shouldn't be misrepresenting escrow.
I lose zero sleep each night worrying about the numbers that I disclose on this form being accurate or not. They will be accurate as close as can reasonably be, So I think it's important for people to know, again, box A is where you compare lenders. That's going to really be the only difference. Box B, C, E, F, G, sometimes there's H, but not in this case. Like, those things should generally be the same from lender to lender. It really is just that box A piece. So I think it's worth mentioning to people.
I like one little thing to add too is like, all right, so Randy and I practice doing it the right way. We give the consumer the documents to review and sign. Why would the number actually be different from the beginning to the end? Proration, number one. So Randy and I are not perfect. Maybe we missed a month. Okay. Our math was off a month. That happens. But there are two to four different tax cycles throughout the course of the year, depending on the town that you're buying in. So when we start a transaction, it's possible, depending on the town tax cycle, that the number actually changes by the time that we get to closing. I hate those months because, with taxes rising, let's use Biddeford and Saco as an example. My taxes went up almost $1,000 year over year. So if you're buying my house and you started the transaction and at the end there's $1,000 increase, your proration is affecting the numbers by, your payment's up almost $100. And number two, it's going to jump the amount that's needed at closing. I hate it when that happens.
Yeah. And it's like you said, it does. But again, that's out of our control. That one hasn't bit me, knock on wood. But yeah, if it did, that would be the explanation. But most people don't realize that that's how that part works. So for anyone that's listening, that hopefully gives you some insight to what we're looking at here. This is a very important page in a real estate or a loan transaction. So I think it's worth spending some time on.
Do you find yourself, sorry to interrupt you, do you find yourself, just because of the amount of reps we've had and the amount of years in this, and it's like the fight or flight thing where you don't want to touch the fire twice if you've touched it once. I feel like so many things have happened to me over my mortgage career where I almost bore people with my over-disclosure at the beginning because I like to use it as sort of a milestone conversation during our transaction where I could refer back to, hey, this is what I told you could have happened. I'm like heavy with that. Do you do that?
Absolutely. I mean, how long have you been doing this now? 20-something years?
22 years, I believe. Yeah.
So I think I'm 16 and a half, something like that. Yeah. But anyways, I have the baggage of all these bad things that have happened over that period of time that shapes everything that I say to people.
Yeah.
And, all those disclosures are, things that have maybe gone wrong or things that I wish I would have said differently in the past. So yeah, it's probably overkill in certain aspects, but yeah, I don't want to leave anything unsaid that, could come back to bite me or, someone could be confused about. So that's what it's all about.
I still find after all these years, there's something once a year where I'm like, what? Why didn't I know that? Like
100%.
Yeah.
It happens like every week. There are so many things, guideline changes and, even things that don't change. A lot of times in this business, you don't know of certain situations until you go through them. Yeah.
Bingo.
Yes, sir. Okay, I'm going to stop sharing my screen. Hopefully this works. And then we'll just work towards wrapping up. All right, Beds. Is there anything else that you want to talk about? I thought that was solid information for people that are still listening. I don't have too much that is urgent for me to talk about today. There's some things I want to mention. We can always save it for next month.
Yeah.
But those are the main things for me for now.
We always start with the year with predictions and stuff. We're almost hitting the midway point of the year. Are you surprised where rates are? What do you think about the inventory levels at this point?
I am surprised where rates are, but I've been surprised for 2 years because every little expert that we hear from has been telling us since 2022 that rates will be lower by this time and by this time. And here we are 3 years and change later. We never, ever hit what those experts predict. And now they're saying low sixes by the end of the year. We'll see. So I very much thought rates would be lower by now, and they aren't. Still waiting for that refi boom to hit. Inventory, I would be interested in what the actual numbers are. It feels to me like people are seeing properties and making offers, and there's a lot of activity. I honestly don't know if the inventory is technically higher or lower than it was last year at this time.
It feels a little busier.
Yeah.
Yeah. But yeah, I mean, midway point of the year, almost midway point of the year, that's the only thing that I've thought about. Is it in a different area than what I thought it would be at this point? And I think the answer is yes. I thought the rates would be lower. I do think the inventory amount is up. Well, the conversations are up.
Yeah. Yeah, whether or not people put stuff under contract, that continues to be a challenge just because of multiple offers and appraisal gaps and all that stuff that we've been dealing with over the past couple of years still exists to some degree out there in that market. So yeah, just grinding through, man. I'm cool ending it there if you are.
This is where we say goodbye. I want to congratulate anybody that made it to this point. We love you. You obviously love us, so thank you.
If you made it to this part in the episode, shoot us a text. Let us know what's up.
Yeah.
We appreciate it. We're having fun doing this. Appreciate all the support, people that mention it to us when we see them, and keep us in mind for people that need loans.
Thank you for listening.
All right. See you guys. Have a good month.